Now to our continuing look at the Nigerian economy and the various headwinds and tailwinds that will determine its course for 2019. Investors are betting increasingly on the nation's financial market dealers, quotations over-the-counter securities exchange, which has expanded its dominance over the last 5 years. As markets continue to struggle into the new year, Nigeria's central bank has made its first intervention for the year. The CBN injected $210 million into the interbank segment of the foreign exchange market, assuring economists that with less than 7 weeks to the 2019 polls, exchange rates will remain stable despite any anticipated pressures compounding the election spending. The CBN reportedly allocated $100 million to the wholesale sector of the market, while the small and medium enterprises received $55 million. Nigeria's central bank also earmarked another $55 million to customers requiring foreign exchange for business and personal travels, tuition, or medical fees. Those allocations come with a dip in total foreign reserves in Nigeria, and word from CBN Governor Godwin Emefiele that the country's target is to maintain a stable currency rate to avoid further depreciation of the naira. Now, Bola Onadele, the CEO of FMDQ OTC, joins me in the studio to discuss this. Good morning, Coco, and welcome to the Global Business Report.
Good morning, Eva.
Well, in a space of 5 years, FMDQ OTC Securities Exchange has grown to be one of the largest financial markets in Nigeria. What would you say are the wins and challenges that have nurtured the exchange over the years?
Thank you. I think we should look at the history of FMDQ.
Okay.
So when people say it's grown to be the largest securities exchange, the market, the interbank market existed before the promoters of FMDQ decided the governance should be around that market.
Okay.
So we do not actually measure the success of FMDQ on the terms of the size of that market. We'll rather look at the footprints of market development that FMDQ has achieved in the last 5 years. In terms of successes, we would also recognize the regulators who have, in different ways, either promoted, supported FMDQ in becoming what it is today. So first will be the Securities and Exchange Commission for registering FMDQ. And after registering FMDQ, allowing it to, I mean, in the first place 5 years ago, there was no model for what FMDQ is today. I mean, the country is grateful that other African countries now come here to study this model. And FMDQ, if you ask me, has become of national significance, an institution that we should all be proud of. But the SEC must take credit for that. The Central Bank also of Nigeria, of course, as you're aware, is a shareholder, and central banks usually take these sort of positions in the formative years of financial market infrastructure of this type in an ecosystem. The Debt Management Office, who at the point 5 years or 6 years ago was sort of, developing the sovereign debt market and allowed FMDQ to take on that role. So we don't look at that size, whether it's the largest and things like that in FMDQ, at least that's not our focus. Our focus is about the market development. And if you're talking about that market development, then there are challenges to talk about. First, FMDQ is a change to the whole ecosystem. There was nothing like that before. The members, the banks decided to have this governing body to drive governance and to drive market development, provide data, transparency, and the things important for a developing financial market. That came with the responsibility of being the self-regulatory organization to them. Also to FMDQ as a corporate, it meant you needed to attract talent to be able to do this, to focus on the market organizer role, the mandate we had, and we all know the position of that in the country at the moment. So we've had challenges in different areas. The members, the Financial Markets Dealers Association, who are the banks, have been cooperative. When we started, we had change to deal with. But I think with increased communication and engagement, the collaboration is getting better, the stakeholders. So if you ask me, we've turned the challenges into opportunities, and
Very modest.
Now a model for other African countries, and even internationally when we go for conferences, my colleagues come back with what people say about what Nigeria has been able to create. And this is one that nobody can take away from Nigeria. So good things happen in this country.
Well said. Now, well, despite the headwinds that caused the drag on the equities market, FMDQ closed 2018 with a record market turnover of 182.2 trillion naira. Now, of this amount, treasury bills, foreign exchange, and repurchase agreements and buyback transactions accounted for about 80%. Why have other products such as commercial papers and money market derivatives lagged behind in performance?
Commercial papers, we started from zero again.
Okay.
In 2009, Central Bank decided to clean up that commercial papers market. And in doing it, the market probably misunderstood the agenda of the Central Bank. The Central Bank wanted credibility into the market. So everyone sort of left that market. FMDQ in 2013, 2014 decided to revive this market. I don't think it's a drag. From zero, FMDQ has now registered 1.6 trillion in programs. There's a lot of work because you have to go back to the corporates and convince them to consider the alternative in debt capital market financing. That takes some work. We're also looking for benchmarks. We wanted a benchmark for telco. There's a telecommunications industry. We wanted a benchmark for manufacturing. With my colleagues, it took us close to 4 years to convince Dangote to come back to the commercial paper market. He used to be in that market and he left in 2009. We've been talking to other telcos to come to the market. So it's easy for all of us to benchmark, the borrowing and the ratings. It's not chasing deposit. It doesn't happen overnight. So there's a lot of work to meet the CFO, to meet the CEO of these companies, to let them understand and appreciate the importance of debt capital market financing, especially if they're going long term. If you look at the size of the economy, you would expect the commercial paper market to be in trillions. But again, we have a lot of work to do with awareness, education. Some people do not even understand yet the impact of Basel III implementation. And the thing, so we're working on all this. Derivatives market is another story. People need to understand that we're talking of the plain vanilla hedging products. When people hear derivatives, they want to run out of the room. Derivatives because of what they've heard about. Derivatives are weapons of mass destruction and things like that. But we're talking of you hedging interest rates. Because these market risk factors, interest rate, foreign exchange, they go up and down all the time. And that's not your business. What you want is to have stability in your business for the risk inputs that you use. And the best thing to do is to bring this stability through hedging. And that's the derivatives we're talking about for interest rate. People that are buying 20-year bonds, that's a person betting on inflation. But what you can do is have that person hedge. So we have our pensions in bonds, we have our pensions in treasury bills, we have a pension, whether we like it or not, linked to the exchange rate because of the store of value. All these assets need to be protected. There's only one way to protect them, and that protection comes from derivatives, plain vanilla hedging products.
Well, what's being done to create that awareness and education for people to know? That's
the work FMDQ has to do. We've set up our academy. We started with phase one, which was e-learning. By this year, I was going to say next year, this year, 2019, we will be going to the face-to-face engagement with stakeholders. We've segmented.
Okay.
We have the different segments, and we will do a lot of work. Again, the board of FMDQ has decided to invest in this area. For us, when we started talking, we're talking about money. The focus for FMDQ at the moment is market development. And we have to invest in that awareness. We have to engage the Association of Corporate Treasurers of Nigeria. We have to engage with other clusters, chambers of commerce, all these areas to let them understand that when there will be factors that lead to changes in all these market factors, foreign exchange. What you should do is to buy products that you will not even bother with that. I mean, elections are coming. We all knew elections will come. What should you have done in your offices about the things you're going to import, the exchange rate impact of that? would have been to have bought
avoid the FX?
avoid that, to have bought the OTCFX futures, which central bank has also bought to the market, which is now well priced and everyone is happy with the way it is. You don't sit down praying about exchange rate. You hedge yourself against it and you do your business. The contracts run for 12 months. So all the things you do between now and December 2019, you have contracts to hedge yourself. So I think it's that awareness that FMDQ has to invest a lot of its resources, time, money, in for people to understand how to react. There should be no panic in the FX market at the moment because the futures are there for people to buy.
We panic every 4 years. Well, other than trading listings and quotations on your exchange, what are the key market developments did FMDQ engage in last year?
FMDQ keeps working on market development. We keep talking about making this market, the Nigerian financial markets, globally competitive. And to do that, there's some things that you have to do. Efficiency is part of it.
Okay.
So for over 2.5 years, we had been working with the central bank to ensure that we introduce straight-through processing to the trading, the secondary market of the government securities.
Okay.
I'm pleased to say, with my colleagues, there was a lot of work with the central bank support and the banks. The Financial Markets Dealers Association, we achieved this in June last year. So now when the traders trade, things settle seamlessly, and we're using technology for that. We also launched the green bond market development. Sustainability is a big issue. We all know the challenges.
What did you call it? The green?
Green bond market development.
Green bond market development.
So I took that. It's underpinned by the whole agenda of sustainability. We all know what global climate change and all those things. So we need to start driving our investments to ensure that sustainable finance plays a major role in this market. And Nigeria has big opportunities in this area. I mean, we can build greenhouses, funds offshore, looking for green opportunities. They want to invest the money, but it's got to go to green opportunities. That is one message that we also take into the market. And that's going to also take time. Most of the things FMDQ invest, we invest with a focus on future, not just today. And that's why at times when people say, I have not seen it, you will see it. The straight-through processing I talked about took over 2 years to involve everyone, engage and seek their approvals. One other area that...
so it focuses on development, impact, and long-term solutions.
Those are the things we do. The beginning of the year, we launched the clearinghouse. And this is also to help the companies and the banks manage the risk. So FMDQ Clear is a wholly owned subsidiary, and its focus is on risk management, counterparty risk management. So when parties trade, we clear for them, we mark to market. It's not too technical. But we ensure that the risk is minimized between two parties that have traded. So once they do their trades, until day of settlement, they all sleep well. These are the things you see in international markets. But talking about our future, one thing we launched this year, which, if you ask me, is the most impactful in this country, is the empowerment, financial market empowerment for next generation. We've started putting kids in classes in FMDQ, teaching them about financial markets. Already, we've done this with the kids in the age bracket of 13 to 15. And this is very successful. This year, we hope to take it on to down to primary school, and then up to the undergraduates, and then youth corpers. So that sort of agenda to prepare Nigerian kids tomorrow. This is our own area, and this is what we want to contribute to Nigeria. Nigerian kids engaged Aliko Dangote when he visited Exchange Place. That's FMDQ's office. Mr. Femi Otedola was there as well, Mr. Gordon Emefiele. But the icing on the cake for the kids was they met Theresa May.
Amazing.
When she came to Exchange Place. And this, leaders spoke to the kids about financial markets. You'll have been proud to see Nigerian kids talking about the commodity market, foreign exchange market, securities market, factors that affect and what we need to do. And that is where, quite honestly, if you ask me, FMDQ's impact. That's the future for Nigeria, not just for FMDQ, but that is what we're doing, and nobody pays for it. FMDQ
pays for that. That's amazing. Now, could you give us your perspective on the market outlook in 2019, especially for foreign exchange and interest rates? In addition, what's your market development agenda for the new year?
On foreign exchange, you introduced earlier the governor, Godwin Emefiele, has assured the market that the exchange rate will be stable. And I think this has been his agenda for years now. He wants that stability to come.
Of course.
But people misinterpret him when he says that. Putting futures in the market is a way to ensure stability of mind for people and in their, in the calculations in their offices. So even if there's a shift, he has put in place a product to make it stable for people. And I think central bank deserves all the accolades on that. So in terms of the exchange rate, despite the gyrations in the crude oil price, I think the governor has promised that there'll be stability. He's done that. I think the governor has put a product in the market. I think people should call their banks and buy futures up to December 2019 without betting, because whilst the governor will try and do as much as he can, and he's always done that, if there's need to make an adjustment at some point for the economic balance, they will make it. But every day he puts the futures in the market for people to buy. If I were a bank, I'll be telling all my clients, this is the time to buy futures and hedge yourself. There's no stability better than that. In terms of interest rate, I think the interest rate is going to be more difficult to predict, especially with the inflation, especially with the spending on the elections. The central bank will obviously be focused on that as well, because the central banks are expected to be proactive with inflation, because if you allow it to go out of hand, it may take you longer time to arrest it. In terms of development this year for FMDQ, the repo market, you talked about repo market earlier.
Yes.
But we want to put a repo market with collateral management. When a lender has given money and has received assets as collateral, as those assets change in value, the borrower must keep topping it up and ensuring that there's no risk to the lender. We'd like to bring that market we'd like to activate it this year. The banks and FMDQ and Central Bank have been working on it. We were meant to have gone live last quarter, but there are things to clean up. We should achieve that. We should be able to push the needle on the derivatives this year as well. We'd like to go into the Treasury bills futures, the FGN bond futures, because all those products and asset classes deserve hedging opportunities. We'll look at bankers' acceptances as well. This is an opportunity for banks again to put their papers out there, and the whole market can see their bankers' acceptances trade in the secondary market, and is a measure of their rating, and also could be linked to their time deposits. So these are three major areas where we're going to be working on. The best one that happened this year, but which will really go live, when I say live, we should start seeing the opportunities, is the daily member specialist market. Now FMDQ has provided opportunity for stockbrokers and the banks to be able to deal in the fixed income market. This has never happened before in this country. So that integration has finally come, and would expect it to take off fully this Q1.
In news from Asia, for the first time in 5 years, Japan outpaced China to dominate mergers and acquisitions on the continent last year. And with a war chest of $890 billion, the island nation's spending spree is likely to continue. Japanese companies announced more than 1,000 offshore acquisitions, totaling a record of $191 billion last year, led by Takeda Pharmaceuticals' blockbuster takeover of Britain-based Shire, according to data compiled by Bloomberg. The last time Japan overtook China by that measure was in 2012. China was fourth worldwide with $105.4 billion in mergers and acquisitions deals, but it is the second consecutive annual decline for China. Japan clinched the top spot in Asia as a trade war escalated between the United States and China last year, destabilized global supply chains, and led to increased scrutiny over Chinese-led deals. Now, Asian markets are broadly higher today after strong U.S. jobs data lifted indices on Wall Street. All eyes are on Beijing, where American and Chinese officials are expected to start talks to try to resolve a trade dispute that threatens to worsen an economic slowdown and put a drag on the global economy. For more on this and other stories making headlines in the continent, we cross to Hong Kong for the latest from Arise Asia business correspondent Joel Flynn. Hi, Joel. So let's start with a look at these trade talks then. What's the latest in the region, Joel?
Well, they are taking place as we speak. Really, it's no surprise to know that getting hold of information in Beijing isn't always straightforward. What we do know at the moment is very little, really, in terms of concrete developments, Idia. We know that the Foreign Ministry today has said both sides want to work together to make progress on this. They've said the tone was constructive and positive. Which appears to have certainly encouraged investors in Asia today. Donald Trump, we know yesterday as well, said the talks were going well on top of that. So the message from both sides certainly does seem to be good news. Having said that, there is a growing sense that if these vice ministerial level talks do fail to produce any sort of concrete results, we could yet see these threatened US sanctions come in earlier than expected. We are currently in this 90-day period, remember, that began at the beginning of December when Xi Jinping and Donald Trump met at the G20 in Argentina. Today at a UBS conference in China, Goldman Sachs' former China boss, a guy called Fred Hu, suggested that China shouldn't try to rush and acquiesce to some of the US demands, though. There seems to be some degree of consensus, for instance, that lower taxes on car imports, new laws on tech transfers as well, all show that Beijing is trying to help make progress on this front. But whether that's enough for both of these sides really is the big question, I think, this week.
Well, Joel, how's all of that been affecting markets in Asia today?
Well, as I said, I mean, investors have taken a broadly positive look at what is happening today, certainly in the context of the dovish Fed comments we had at the end of last week and the non-farm payrolls jobs data out of the US as well. All of that has really combined to contribute to something of a relief rally today. Chinese stocks were also helped by a move from the central bank here to ease its reserve ratio requirement. That helped lift the Shanghai Composite about 0.7%, while blue chips in the Chinese mainland gained about 0.6%. The broad optimism was tempered, though, by all this uncertainty that we have had. That continues to undermine gains in Greater China. Hong Kong certainly was tempered by those concerns, the Hang Seng rising 0.8%. Tech shares leading the benchmark higher, but investors elsewhere in the region appeared a lot more positive on all of this news. South Korea's Kospi was up about 1.3% today. Shares in Japan absolutely soared. The Nikkei added about 2.4%. A big rebound after the heavy drop that we'd seen in Tokyo at the end of last week. Southeast Asian shares mostly up too. Firms in the Philippines hitting their highest level in more than 7 months. Taking into account local factors there. And Aussie shares also climbed to a 1-month high, and Indian stocks echoed broader gains across Asia.
Okay, Joe, well, let's talk about Huawei, who's clearly a big player in this whole trade tension between the US and China. Now, the company's been tapping into new growth channels to try to get around all this recent trade issues. What more can you tell us about this?
Well, Huawei have today launched a new chipset for use in computer servers. It could be a big development, really, for the tech giant, which, as you might know, is more well-known across the world, certainly, even if it's less so in China. It's more well-known, really, as a smartphone maker, as a telecoms equipment maker. And it's really in the midst of trying to make a push to enhance these chip-making capabilities that it has been toying with. In part, that is in the context of China's broader effort to reduce heavy reliance on imports, in particular, of course, from the United States. And it is trying to grow its cloud computing and enterprises services alongside all of that. Now, these new chips themselves, they are based on the ARM architecture. That is a rival to Intel, which Huawei currently has a fairly hefty partnership with. Huawei has said it will continue this partnership regardless of its own innovations in semiconductors. But Chinese firms, of course, are trying to minimize the impact of the trade war on their own bottom lines. They are still trying to make money nonetheless, so they're not just going to cut off their noses to spite their faces. But in the broader context of national security concerns and the strategic importance that Washington and Beijing clearly attach to this technology, certainly this does seem to be a leap forward, really, regardless of how great it is for Huawei itself.
Well, Tesla, meanwhile, seems to be taking a big step forward today, Joel, apparently about to break ground with its Shanghai factory. What can you tell us about that?
Well, Elon Musk tweeted overnight that Tesla would be breaking ground on its production line in Shanghai today. The Shanghai Gigafactory will begin making Model 3 electric vehicles by the end of the year, according to the Tesla CEO. We haven't had any confirmation or seen pictures of this yet. But we do understand it will be going ahead. The $2 billion factory will be the company's first, of course, in China, which is the world's biggest market for cars and vehicles. Domestic production will help Tesla certainly get around some of these tariffs and taxes that have been troubling international autos manufacturers. Now, new energy vehicles are another area on top of semiconductors where China is really trying to ramp up innovation. Tesla obviously wants to be here on the ground to compete with local producers. And car production, we know as well, for instance, back at home, has been a key issue for Donald Trump as well, even if it has, for instance, been more focused on traditional fossil fuel powered vehicles. The Tesla factory will be a big deal for China. It will be the country's first wholly foreign-owned car plant. That is part of this, some of these opening up measures that Beijing has been trying to make. I mentioned those a moment ago, and that's really a key point, certainly, in the trade talks that are happening this week.
Definitely very big news there for Huawei and Tesla. So tech companies are very much at the heart of what's happening in China then, Joel. Now, it also sounds like they're trying to find more ways to raise money on the markets. Is that right?
Yeah, China is also planning a NASDAQ-style board for stock listings here. That is to help some startups raise money. Tech firms hope the current plans could help them get around tough hurdles to IPOs elsewhere, help them get more funding more easily. More than 2/3 of all the money that is raised on stock markets across the world by Chinese companies last year was abroad. It wasn't at home. And there's a lot of sensitivities to foreign funding for tech firms in China. The worry is really that previous attempts to do something similar to the NASDAQ in China haven't quite taken off as they had hoped. One thing that might be encouraging, though, is that policies by Donald Trump's administration have all but halted Chinese investment in U.S. tech startups. Now, that could mean more money comes into Chinese companies back at home. It might, though, also mean less Chinese access to some of these sophisticated U.S. innovations that Washington and the White House have claimed are part of these forced technology transfers and IP infringements. So we will see how these things play out. Certainly, there is a lot of excitement among some of the tech startups here in China about what this new board could mean for them being able to raise money.
Well, we'll also see how the talks play out and what this means for both the Chinese and the U.S. economy. Thank you, Joel, for joining me today. Always a pleasure speaking with you.